Guys, I'm sitting here with Rick Sager. Rick, why don't you introduce yourself and tell us a little bit about what you do to frame today's conversation?
Thanks, Luke. Glad to be here. Love talking taxes, and as I'm sure everyone else is.
Oh, yeah, love it.
Sager CPAs and advisors, headquartered in Meridian, Idaho, office in Garden Valley, Idaho as well. I founded the firm back in 2012 and started it and just on my own. Now today we've got 20 people working for us throughout the world. Tax strategy, tax planning is our forte. That's really where we hang our hat. Check out our website, sager.cpa, kind of a unique domain, but
Cool.
sager.cpa. Lots of resources and stuff there. Glad to be here today.
Yeah, thanks for being here. And I'll say that you got 20 people working with you, but it's never felt that way for me. It's always felt like I was working with you as my CPA, and that's remarkable. Good on you for that. And I guess today we're going to jump into a conversation, guys, that's going to focus a lot around bonus depreciation because it's been a huge part of my strategy for wealth creation. And not only does Rick understand that, he teaches a class in it as well. So rather than hear it from me, I wanted to bring Rick down here for some authority on the subject. And we're going to talk about that today. And hopefully this is in time for your end of year strategy conversation with your CPA. If you don't have one, holler at Rick. Let's jump in. Yeah, and I guess I would start, Rick, like, why the hell become a CPA?
Long story. I couldn't afford law school. So there's step one. I graduated, got into law school. It was during a recession. Couldn't really find a job at that point and realized the jobs that were available were in accounting.
Yeah.
I didn't like accounting, but I love tax. I love strategy and everything goes into tax. And so
Tell me what the difference is, because I know I ran into this when I was looking for a CPA. It's like when you get started, you're like, I want my CPA to keep my books and then also file my taxes and then also be a strategy partner. I've found that those are different buckets. Can you help me with that? Like, tell us what's the difference? Like, why you love strategy? How does that differ from accounting?
you bet. Accounting is keeping track of stuff. Accounting is knowing where dollars went, where dollars came from, where they're going to go, and really keeping things in order and in line. Strategy is now we've got those things in order and line. We have data in front of us. What do we do with this information? What do we do? How do we look at the numbers and then look at what's available to us in the tax code and say, hey, is there opportunities? How can we get these things to work together for our advantage? So I'm glad you asked that question because I've had clients come to me and ask for strategy and help, but they don't keep books for their business, or if they do it piss poor, and I can't do my job based on piss poor data. We got a phrase in the industry: garbage in, garbage out.
Yep.
And so that's really what it kind of boils down to. And I mean, I'll admit I'm the nerdy accountant. I like to reconcile, books and numbers. I like it when they tie out. It's satisfying. But for me, the reason I got into this industry and what drives me every day is the strategy side of things with clients. I'm the nerd that read the One Big Beautiful Bill when it got passed this summer.
Nice.
I was on family vacation, saw the headline that it passed. Boom, let's dive in and start reading.
Sitting by the pool.
Yep.
Nice.
I have my kids drive. I said, you guys drive to the next town. I'm going to be reading. Because I love learning that, because the better I can understand it, the bigger my toolbox. And then I can come to my clients and say, hey, I think this part applies to you. I think that part might apply to you. And to me, it's fun. I get it. It keeps my mind active and engaged. I can do this forever.
You're obsessed.
I think I am. Yeah.
So One Big Beautiful Bill, that's a good segue, because I know, like, I was teaching a class on depreciation about 3 years ago, and it was really exciting. And then it started to taper off, and cash flow got a little tighter. And so maybe the strategy was more important, but people cared less about real estate investing. Like, what about this last bill made real estate exciting again?
It made permanent, and this is huge, it made permanent bonus depreciation. Folks have probably heard that word a lot. In fact, on the drive here, I heard a radio interview with Eric Trump talking about bonus depreciation. Background, so bonus depreciation was enacted in 2002 as a way to spur the economy.
Still pretty young then.
Yeah.
Wow, I didn't know that. Okay.
And at that time, it was only a 30% bonus. So prior to 2002, if you depreciated something Generally speaking, you depreciated it evenly, give or take, over the life of that asset. So if it's a vehicle, if it's equipment, it's over 5 years. If it's real estate, it's much longer. Commercial's 39 years, residential real estate's 27 and a half years, generally speaking. Bonus comes along and says, hey, rather than having to spread out that depreciation over the 5 years, we'll let you take 30% of it right up front this year. From 2002 on, there was various levels of bonus. Sometimes it would be up at 50%. The Tax Cuts and Jobs Act back in 2017 made it 100%. And then it started tapering down. And just last year in 2024, it was much less. I believe it was 40% or 60%.
I think on paper it was 40, or at least that's what it was supposed to be. But when we were talking, there was some kind of a grandfather clause too, like something carried over.
Well, for this calendar year in 2025, if you bought something January 1 to January 19, you get those old rates.
Oh, burn.
It's like 30 or 40%. Yeah.
So there's a tip, guys. Don't buy in January. You got to get it in service calendar year. You want to offset the taxation.
Yep. So now the One Big Beautiful Bill made that bonus depreciation not 30%, not 50%, 100%. So you buy a piece of equipment, piece of furniture. It has to be qualifying property, but for purposes of this explanation, you buy a new piece of equipment for your factory, you can take all of the depreciation on that now, today. And from a capitalization standpoint, you don't have to pay for it either. So you can finance the piece of equipment, keep your cash, keep your capital, and still get this write-off or this depreciation item because of bonus depreciation. And here's the best part, I think. The One Big Beautiful Bill made this permanent. So no more, it's this amount 1 year, it's down the next year. 100% permanent.
Yeah, so worth talking about too, because I know this came up a lot when I was talking about depreciation. People are like, yeah, but it's only 60%. Now, it's awesome that it's 100%, but my rebuttal at 60% is that's still a ton of money. Like 60% of and you were talking about trucks and furniture. I mean, real estate assets is why I get excited. You can easily finance a real estate asset and own the entire depreciation value of that property to offset active income as a real estate professional. And we could dive into that a little bit more, but 40% of let's say the depreciation value on a $500,000 home is $125K. 60% of that's a lot of money to save in a single year for taxation. And then the other part doesn't go away. Like, I think that's where people were getting hung up is like, yeah, you take 60 this year, you get 40 next year. It's like an account that you can draw from as you have high earnings that need to be offset. Does that sound right? Check me on that.
Yeah, I mean, it's commercial real estate versus residential real estate, similar but different sides of the airplane, if you will. Commercial real estate, the shell of a building, still going to be depreciated over 39 and a half years. But if you make the stuff inside of it new, so they call it qualified improvement property. That's the term QIP.
These are improvements that qualify. Is that what it is? Okay.
So let's take a commercial structure. You build the shell, so you build a roof, you build walls, and it's got ground, but there's nothing inside of it. That stuff is going to be over 39 years. But then you go inside and you add wiring, you add flooring, you add partition walls, fixtures, cabinets, go down the line. All of that stuff qualifies for bonus depreciation.
Got it. So then there's an opportunity to buy a building that needs a remodel. And I think a lot of times commercial buildings require you to build them in anyway, right? So it's really that build-in is then depreciable.
That's right.
So, and we're dancing around the word depreciation like everybody knows what we're talking about. Can you help me with that just so that I don't have to explain it? Like when we're talking about depreciation, what specifically is that?
Yeah. I'll try not to be too nerdy here with my accountant
Nerd,
speak
baby,
and stuff.
nerd. Give it to me, dude.
A lot of people use the phrase write-off to talk about buying something and getting a tax break for it. So if you pay for a cup of coffee, it's a one-time use. It's done with. There's no further benefit. You buy an asset like a house or a commercial piece of real estate or piece of equipment, you're going to get multiple uses out of it. We call that having a life. And so, under the tax code, you have to not just before bonus, you had to take the cost of it and spread it out over the life of that asset, and then you would get to write off, if you will, that year's portion of the life. So you bought $1,000 piece of equipment, and it's got a 10-year life.
Is that like a computer?
Sure.
To make it a real example, okay.
Yeah. Let's do it differently. Let's do a computer. Let's say it was a $500 computer. It's got a 5-year life. You get a $100 depreciation write-off every year for 5 years.
Right.
Generally speaking, that's what depreciation is.
And so like the active versus passive income piece is like scratching at the back of my mind. Like I know with real estate, regular people like W-2 employees can actually take advantage of depreciation in a line depreciation environment to offset passive income. But there's real limitations to their ability to offset active income. Am I close?
You're exactly right.
Okay, and then like the active income piece becomes where real estate professionalism becomes exciting. So like maybe you could help me by framing active versus passive income so that it's coming from somebody of authority on that.
You bet. So this all goes back to 1986. Congress passed legislation that said, to put it clearly, all rental real estate is passive. And from there have been 2 exceptions carved out. And let me pause there if I could. Passive versus active. Passive meaning you're not working for the money. The dollars are doing their job for you somewhere else. Active meaning you got to show up and do the work to get paid. So what happened there with that limitation back in 1986 when they called all real estate passive, it prevented, the billionaires, if you will, from buying big buildings, depreciating them, and offsetting their income, their interest, and other things like that. So now, yes, as you alluded to, there's 2 carve-outs for people that, let's say you're a working guy, you got a job, and you own a rental property on the side. If your income is over $150,000, you don't get to take the losses on your rental. And losses is kind of a two-edged conversation. There's cash flow losses, and then there's tax losses. The rents you collect might cover the mortgage and the repairs and maintenance and the payments. So you might have a net positive cash position, but once we factor in the depreciation on top of that, or subtract it, I should say, you could on paper have a loss. And so you've got this loss. If your income's too high and you have a day job with a W-2, for example, or a business, and your income's too high, that loss does not get to offset your wage or your job. Now, it doesn't go away, but it rolls forward to future years when you do have positive rental or passive income, and it can offset that.
Like when we talk about bonus, it's like we're taking that, to use residential time horizon, 27-year cycle in a single year if we can. So what you're saying is you can still have the depreciation work for you, but you can't bonus it. Is that right?
You can bonus it, part of it, but if your income's over that 150 mark, it's going to sit in this bucket as this unused loss, and it's going to carry forward. And then every year that you have a gain from that rental property, that gain's going to be absorbed by this loss that's rolling forward.
And that's how depreciation offsets passive income. Because what you're saying is you're making 150. I don't know that distinction either. Maybe you could talk a little bit more about that. But what you're saying is the depreciation can offset the income from the property, but you can't then use it to offset the money you're making working.
That's right.
But there is a distinction. Where's the loophole? Because I take advantage of that as a real estate professional.
Yeah, so here's the loophole. If your income's over that level, but you qualify as a real estate professional. What's a real estate professional? There's metrics for you have to spend a certain number of hours in real estate related activities. Real estate lending does not count, but management, sales, those kind of things
Development,
do count.
redevelopment, remodel. Like there's a pretty wide basket. And if I'm right, it's 750 hours you got to work in there.
That's right. And if you got multiple properties, then it gets a little more complicated about qualifying. But yes, that's the number. Side note on that, it's very important people document during the year when they reach those hours. Where we've seen people get in trouble with the IRS is they say they're a real estate professional, but they have no documentation to substantiate that they meet the hours requirement.
What would that look like? How would I document that?
It's can be pretty informal, but maintaining a calendar and it says on this day I did these things, these tasks, real estate related, and how many hours it was. And you can keep a spreadsheet, you can keep a handwritten ledger, but it needs to be something that's maintained along the way. Can you go back and make it? Probably, but it's going to be looked at much more skeptically.
Right. So if you're maintaining a Google Calendar per se, and you could show activities related to real estate that accumulate to 750 hours, basically you're bulletproof.
Yeah. In fact, I would even keep my Google Calendar and I would have a Google spreadsheet that says this week it was whatever total hours.
Yeah, I'll have to introduce you to some real estate agents. We're not that organized.
Well, it is, right? The phone rings and all of a sudden, now you're doing it. And it is. That's why it's better to do it in the moment, in the day, in the week, as opposed to at the end of the month. I can't remember what I did yesterday, let alone last month, let alone a year ago. And if you get audited, oftentimes it's 2.5, 3 years later. Good luck remembering the details at that point.
So is this a situation where I have multiple jobs? Because let's say I don't have any other distinction other than real estate professional. Does it get easier for me? Like, because I know you can't work more in a different industry, like 750 hours, plus that has to be the bulk of your activity.
Yeah. So, your professional services. So I'm a CPA, which means that as a full-time CPA, I would not qualify for this because, I could get to 750 hours, but the bulk of my services are still spent in the CPA tax world. Right. So the 750 hours is not applicable to me.
You're in the wrong business, Rick.
I'm in the wrong business, man. Although I am a real estate investor, I love real estate. I think it's a great play. Not only does it have good tax benefits, typically it's an asset going up in value. It's got great tax benefits when you exit, amazing strategies there. And my clients who have exited their businesses and done phenomenally, nearly every single one of them had real estate attached to their business. It's an extra asset.
Tell me more about that. So you're saying they sell their business, part of their business was real estate assets, and they come out ahead because the tax advantages?
Yeah. So maybe they sold their business and their business, take a dentist. They sell their dental practice. Well, the practice is still in the building. They might retain the building as an asset. So now the business they sold is now paying them rents. And then someday when they exit the building, there's tax deferred mechanisms, or they can pass it on. They can gift it to other people and whatnot. Exiting real estate has quite a few plays that can be employed for tax benefit purposes.
I met a guy once who bought a building, moved his business into that building. The 10-year lease he signed on that building doubled its value, and they sold the building and kept their business in place. So bought a building for $1.5 million, sold it for $3 million just after signing a lease agreement.
Holy smokes.
So the commercial real estate side gets pretty exciting because you could take that in a refinance as well, which is a non-taxable event, which is one of the reasons I get excited about investing in real estate. If you have a long horizon, a non-taxable refinance capital cash out, that's the most exciting tax play you can have as far as I'm concerned. Like, you don't need to move it into another property. You can just cash out and go on vacation and not pay taxes on the gain. Am I close?
Yeah, that's right. And yes, you do have a debt that has to be repaid, but correct, cashing it out does not trigger a taxable event.
Yeah, and that's the beautiful thing about the debt involved. The leverage involved in real estate makes it exciting. And maybe that's a good time to talk about, like, why invest in real estate, because I know a lot of people right now are trying to get into Bitcoin. They're excited about the stock market because it's been on a run. There's a lot of maybe upside benefits of those two asset classes. But when I look holistically at real estate, it's very hard for me to want to put my money anywhere else. And maybe I'll run that list in front of you and you could tell me what I'm missing and then maybe pick the part you like the best and talk about it with me. Is that cool?
Sounds good.
Yeah, I mean, first of all, the leverage. You can borrow money to buy the asset. When you do that, you're multiplying your return. If you make 10% in a year on borrowed money, especially at let's say a 25% down payment, it's a 4 times multiplier on the cash investment, which is hard to do anywhere else. Show me another asset class with that sort of leverage potential. Then you get the depreciation side of things, which is as a real estate professional, and with your help, Rick, I'll tell the story of my struggles before I met you too, just so that people can understand the importance of a CPA on their team. But the idea is I own all the depreciation, and as a real estate professional, I make it a point to buy a building every year so that I can offset active taxation on my active income, which you got me a pretty sizable return. I made good money last year. You got me a sizable return because I kept the house I used to live in and bought a new one. So that the fact that you own all appreciation and all depreciation, so if the asset improves, you've got a leverage multiplier and the returns are yours. You can use the depreciation to offset passive and active income as a real estate pro, which is most of the people who are going to be watching this. And then let's see, you get to participate in the community in a way that you can't otherwise. Like, I think the community involvement can be sort of like, I got a buddy who's investing in memory care facilities right now. And like it's like purpose-driven investing, which I think is hard to find in a cryptocurrency. You know what I mean? Like it got a selflessness to it. I'm not saying there aren't selfish benefits. I'm just saying you're participating in a utility item, which I think is exciting. And then there's the cash flow, and like maybe that's what everybody thinks they're coming to property for. But I know over the last 4 years, cash flow has been flat, and that has not stopped me from moving into real estate because holistically, there's no better way for me to spend my money. Like guarantee a loss in taxation or take a risk in a market with historical upside potential that is outmatched because of leverage and a pretty clear trajectory up. What am I missing, Rick?
I had a client just recently that we had that similar conversation where looking at an investment property, and he says, Rick, I can't make the numbers cash flow. I can't do this deal. It's not jiving. And we looked at it, and he looked at it from a purely cash flow perspective. Rents collected, expenses, loan payments, net cash left. And it was barely not cash flowing. But then I said, well, you're only looking at part of the picture. You got to look at what this is going to do to your income tax bill. And so we factored in cash flows from a monthly perspective. Hey, you were going to pay the IRS in the state X dollars come tax time. Add that back to the monthly cash flow savings. All of a sudden, this property well more than cash flowed.
Totally. Yeah, and I guess that's where I get really excited about it is like I kept my last building. And I've taught a class on depreciation before, and anonymous feedback at the end was like, this guy is only making $3,000 a month in cash flow. Like, what an idiot, That year I made $1 million and paid zero in taxes. So the reality is the cash flow for me it's a risk assessment position, whereas I want the building to pay for itself. I don't want to come out of pocket on the building, but if I can get neutral or better, what I save in taxes can be in the $30,000 to $40,000 range. Which, if you take that and spread it over the next 10 years, where potentially there's a refinance opportunity to improve my cash flow position, potentially rents will increase in value, and most likely the building will also appreciate. Like, I'll sit neutral to save $35K this year to then have the upside potential of the owned asset over time, like all day. In fact, when you start looking through that lens, not buying real estate becomes reckless because you're guaranteed to take a tax loss at the end of the year if you're making over $150K. There's not so many standard deductions that are going to knock down high earners like real estate agents. So,
and if you're in real estate as an agent or in that capacity and you have the inside scoop on properties and whatnot, I jokingly, but kind of not jokingly say, if you're in real estate, you should not be paying taxes because this is available to you. Yes, real estate's it's more involved. You're buying an asset and you're kind of married to it, so to speak. But golly, I mean, I look back to the housing crash in 2008, 2009, and I had a lot of clients who were over leveraged, as we did around the world. I mean, banks were over leveraged. Banks failed.
Everybody.
Yeah, all my construction real estate people say that the spigot just got turned off overnight, and I remember how difficult that was. But a lot of people came in and were able to seize great deals on properties, lock in prices and values. And because of that, I was told, and you probably know better than me, Luke, that started the housing shortage because we stopped building. I've heard numbers of like 4 million people were then displaced, or there was that shortfall in housing nationwide. And then, of course, it's gotten worse and worse. And I guess I saw an article with Biden's open border policy made it even worse. Is the spigot going to be turned off again? Who knows? But it's a pretty safe play. Now, this is not investment advice, but it's a pretty safe play. I personally am trying to get more into real estate as well. I just completed a project recently. I think the long-term upside to real estate is still very, very bright. I like your phrase reckless, actually. That's a pretty good one. If you're a realtor and you have that inside track, you should every year be close or be considering a property for yourself. And if you're not, go look for one.
And there's so many ways to do it, Rick. I mean, you talked commercial. You can buy a building and run a business out of it. You can buy single family, multifamily, small multi. Like there's so many opportunities. Even holding land as a development opportunity and paying very small taxation on it because of an ag exemption. There's so many cool things you can do. Now, granted, the land play doesn't really give you a depreciable asset, but it's like real estate agents who aren't investing are also missing the opportunity to have the confidence of skin in the game. And I found that to be a huge advantage for me as an investor. Investors found me and trusted me because I was investing. So if you're selling real estate but you're too afraid to own it, like that's a red flag, man. Like there's no real reason for anybody to want to work with you, especially in the investing space. So save some money on taxes and then potentially also earn some confidence and some points with your investment group. I know that was a big deal for my group. They're like, wait, Luke's still buying? All right, let's go out there and get some assets. And we were buying aggressively in 21, and people are like, you idiot, that was top of market. And I'm like, yeah, and bottom of money cost. The properties I bought at top of market are actually probably worth 5% more over the last 5 years at this point. On a leveraged return, that's a considerable cash on cash return. And then also, I have investment rates in the 3.5% range, which creates cash flow. You could not buy those buildings today at a discount of less than 30% and have them be in a cash flow position.
Wow.
Yeah, it's pretty remarkable. So like when the numbers move and move quickly is what I learned in 2021. And then by running that strategy and saving a ton of money in taxation, it positioned me in a way to be stable now while other agents are falling to the wayside because I have assets to fall back on, sellable assets for that matter, but also cash flow assets. So it's this moment where the grind of real estate agency can be dramatic because when you're either rich or poor, it comes in at once. Mm-hmm. Managing money isn't our strong suit. When I buy a building, I consider that money buried in the backyard because the recapture of the depreciation eats into the equity, and it makes it less exciting to try to day trade property. So if I'm really investing in my future, I buy a building with the intention of never selling it. And then at passing, the tax basis resets and I can give those assets to my family at no capital gains. That's the part everybody forgets about. They're like, well, you're going to 1031 exchange indefinitely? I'm like, yeah. And then when either me or my wife passes, my kids get that portfolio at a tax basis reset, meaning the $1 million we've accumulated now doesn't have a capital gains associated with it. Oh, and it is cash flowing probably hundreds of $1,000s a year at that point. Like, yes, please. Why wouldn't you do that?
Yeah. I had a client a few years ago that he kept getting into properties, and every time he did, highly leveraged. And then a year or 2 or 3 later, he would sell, and he'd keep making gains and keep having wins. And I said to him, man, you're doing a pretty good job winning at this. And he goes, well, you have to be in the game to win the game. So
Amen.
To your point about if you're not buying, you're not even in the game. You're never going to succeed if you don't at least get that first.
Totally. And your point on the inside scoop, like as a real estate agent, we have our finger on the pulse of the market if we're doing our job well. So my agents out there, like you got to start buying real estate. But I want to shift the conversation a little bit to the position of a tax accountant on your team, because I think like I've read books like Profit First. I've read a lot of stuff to try to get my own budgeting together. What I've found is a focus on budget is a focus on scarcity. So focus on your income. And the second piece is a good tax strategy in as a real estate professional outweighs a budget any day of the week. So stop budgeting, start buying real estate, or start budgeting to buy real estate, and then the tax professional on your team becomes important. So I'm going to ramble for a minute here, Rick, because
Go
when I
for it.
got
Preach.
started, it was like young gun, about to break the mold, quit my job as an electrician, and went into real estate. And I was reading aggressively Robert Kiyosaki and his advisor series. I realized the importance of a team. I was meeting with CPAs before I even had an income, like building the team, so to speak. And like you don't know what you need until you create the money problem. So the first problem of real estate, the first money problem is a no money problem. The second money problem is a what do I do with all this money?
Mm.
And when in sales is the fastest way to arrive at a money problem, the second money problem, which is now I'm making all this money. What do I do with it? And I read the Real Book of Real Estate by the Robert Kiyosaki, by the Rich Dad Poor Dad series, and it talks specifically about depreciation. And I built my strategy on the backs of books like Unfair Advantage by Robert Kiyosaki. Like those things started surfacing. So I knew I needed to be buying real estate to not pay taxes. But I would go into CPA's offices and they would try to talk me out of depreciation as a strategy. And to my agents out there, like you've been through this. If you're not through this already, you're unclear what the qualifications you need in a CPA are, because it's a little bit like going to a doctor's office. It's like, well, it's a doctor. It's like going to a CPA's office. You think there's some qualifications that a CPA should have to help you strategize, but a lot of them are just bookkeepers and filers. They're not strategists. Is that fair?
Yeah, it's crazy to hear some of these CPAs that almost take an approach of they defend the IRS. I don't know. Maybe in their mind they think they're protecting their client. I've seen that too many times. And it's just crazy. I mean, you said I'm obsessed about it. It's a passion. If it's not fun to them, maybe have a conversation a little different with them. I don't know.
Well, my takeaway was you have to have some baseline understanding of the strategy you're trying to run. Like it's pretty scary to walk into a CPA's office with no idea what you're trying to accomplish, because even the best ones can't tell you what you're doing. They can, and to your point, you probably have sloppy books and it'd be hard for him to see into your business anyway. So the idea, the conclusion I came to is it's up to me to know what I need to do and find a tax accountant who understands it. But that strategy piece, like if you're trying to save money on your accountant, it's like trying to hire a real estate agent with a reduced commission. The end of the day is your net outcome is better with better professionals. And the idea that they should cost less is a miss. And then if you can have somebody when you are meeting with CPAs, which all of you should be doing now, you should be finding a CPA for your team. When you're winning, you need one. And the question is, how do you feel about bonus depreciation? I think that's a good qualifying question for a CPA. And if they're trying to talk you out of it, it is not because you shouldn't be using it. And I hear this all the time from people. They're like, well, my CPA said it was not a good idea for me because of where I'm at in life, or, the IRS, this or the other thing. It's they don't know how to lead that conversation. They want to talk you out of it because they don't understand it. And maybe they're trying to protect their clients from the unknown and they can't lead into that space. But if you don't have a CPA that understands depreciation, you're dead in the water from a tax strategy standpoint, because the secret sauce for us real estate agents is depreciation. How do you feel about that?
Yeah, and we briefly earlier talked about how commercial real estate qualifies for bonus depreciation. It's also eligible for residential rental real estate. I think maybe I'm getting ahead of you here, but you've done a lot of work with me on different, what we call cost segregation studies.
Right on time, dude. Let's have that
Oh,
conversation.
my heavens. I mean, I hear people, kind of what you said, they'll say, oh, my person told me I shouldn't do a cost segregation study. Let me make a blanket statement, Luke.
Please.
Should cost segregation studies be applied in 100% of cases? No. 99% of cases? Probably.
Right.
So I think people need to look at cost segregation from a standpoint of, I'm going to do it unless there's an exception to the reason not. And there's a few, but generally speaking, the cost segregation is an important, valuable tool. And I think by default, people should wire themselves to say, every time I acquire a new property, I'm doing a cost segregation. The exceptions to that will be fewer than the opposite approach of should I or shouldn't I. Love cost segregation studies. For those who don't know what it is, you take the property, you engage with an engineering firm, and they'll say, hey, yes, the property might have cost $500,000. And instead of us depreciating that over the straight number of 27 and a half years, this engineering firm is going to say, okay, we're going to assign a value to the roof. Maybe the roof is worth $40,000. And the exterior windows are worth a number, and the walls and the foundation and the sidewalks and the landscaping and the sprinklers. And that's just outside. Then we go inside, the walls, the carpets, the flooring, the wiring, HVAC, appliances, you name it. Pretty soon we have a list of 45, 50, even longer components of this house. And some of those, yes, they get depreciated over the 27 and a half years. But a lot of those will qualify for shorter lifespans, 15 years, 5-year lifespans like carpet, that kind of stuff. And those are what qualify for bonus. So in a $500,000 house, instead of just getting, a flat, can I put my calculator and do some math real quick?
Yeah, please. You're an accountant, aren't you? Yeah, do that.
So we don't typically depreciate land, but land improvements can be depreciated.
Like what? Like fencing?
Sidewalks,
Okay.
certain drainages, that kind of stuff.
Got it.
So in my example, let's just say that the bare land without any improvements cost $100,000. So we paid $500 for it. The land's worth $100,000. That leaves me with $400,000. I got $400,000 to depreciate over 27 and a half years. That gets me up to $14,545 a year that I get as a write-off for 27 and a half years. That's pretty cool. Well, on that $400,000 house, in my experience, we can typically find anywhere from 50 to 80,000 to maybe even 100,000 of qualifying bonus depreciation property. That gives, instead of a $14,000 write-off right now, I got an $80,000 depreciation write-off this year.
Right.
All because of the cost segregation study. Phenomenal.
And if you're making the kind of money it requires to invest in real estate, you're taking that off the top of your top bracket.
Yes, sir.
So you end up saving 30% on that money, which is tens of thousands of dollars. Like back when it was 100% and the market was ripping, I used to say that bonus depreciation was like a punch card for buying houses. You buy 4, you get the 5th one for free because the money you're saving on taxes can be reinvested into real estate, because real estate is a capital intensive investment. So the preservation of capital becomes one of the most important games you can play in real estate. And that's why the taxation piece gets really exciting, because that's 20 grand you don't give to the government, sometimes 30 grand, depending on the value of the property. And you still get the benefits of the shell depreciating over 27 years. And we're in Idaho. Idaho doesn't honor at a state level bonus depreciation. Is that still true?
I think for this calendar year, 2025, I think now they do.
Because of the big beautiful bill, like where everybody's getting in line, or?
I'm going to have to go fact check this, but I believe the Idaho legislature back in the spring conformed to bonus depreciation.
That's beautiful.
I'm going to have to go do my homework on that to confirm it, but I'm pretty certain on that.
So if we were missing that the last couple of years together, does that mean now we get to look at the depreciation that we didn't bonus and now bonus it at a state level?
No, you're still catching up on prior years, but now moving forward, Idaho will conform on the bonus and no more having to track them separately.
So this is really like, if you are this year buying real estate, you can count on state level bonus depreciation. Everything you bought prior to this year doesn't now show up as bonusable.
Correct.
Okay. Come on, Rick.
Well, however, it's not, you haven't lost out, because even though you didn't get the state bonus earlier,
right,
now the federal amounts for yours might be a little bit lower, but the state's going to be catching up. So you'll have bigger depreciation numbers now for anything prior to 2025.
Right on. Well, that's always been one of those, like, I don't know how it was hurting me, because every year I don't pay taxes working with you. And until I met you, it was like I walked into a CPA's office who promised he could run bonus depreciation. He messed something up in his software and told me I owed the government $104,000. And I was like, and I mean, granted, I had a big year that year, but I'm like, hang on, buddy, let me just do the napkin math. And I'm no mathematician, right? I'm just on the back of a napkin sketching this out. I like rules of thumb. I like sort of measuring sticks. So for me, it was always about 20 to 25% of a building is bonus depreciable, like the value of the property, at least in the single family residential space. Running my math backwards, turns out he missed a couple of checked boxes in his software, which was going to cost me
Holy
$50,000.
cow.
Yeah, and that's the next year I met you, and you said, Luke, if we were working together, you would have paid nothing in taxes. And I was like, damn it. And it's hard to go back, but that was a good hard lesson for me. Like sometimes when you lose as an investor or a professional, it's because there's a lesson you need to learn. So I don't want anybody out there beating themselves up for not knowing this stuff already. It's really like look forward through the lens of real estate professional as a unique loophole that accesses some of the best tax advantages for regular people. Is that close?
Yeah, and you've already said this. I'm not spilling any secrets here, but I mean, you don't just talk the talk, you walk the walk.
Thank you.
You're an investor. You've employed these strategies. You've helped other people employ these strategies. I've seen that firsthand. And so, yes, you're a person that understands this. You're doing it. The advice you just gave is great and it's sound. And I hope people really take it to heart and employ it because it's I don't, almost like low hanging fruit. If you're a real estate professional, you're in the game already. You have access. Number one, you got access. You qualify as a real estate professional if you're an agent or something like that. All you got to do is pull the trigger, buy those properties, and now your money's working for you.
Yeah, and I firsthand have experienced the confidence and success that comes with skin in the game. I can't overstate that piece. Agents that are afraid to buy property are also poor leaders in the field, and they tend to perform worse than people who own property. And the reason is conviction in the asset class. If you can say and understand why the investment of real estate is better than almost any other asset class and have some dialogue as to why, you find better buyers. And then I spend a lot of time talking sellers out of selling property because I believe so wholeheartedly in holding long term. So all of those things have given me an upward spiral. And it really is the first part is you don't have to pay taxes if you buy real estate. That's a me thing. And then it becomes sharing that message with people. Like I've brought clients to you that took 3 years to convince that bonus depreciation was designed for people like them because their CPA didn't know how to do it and spent 3 years talking them out of it. If I could go back for that guy and have better dialogue to convince him earlier, I probably would have saved him millions. And at this point, he's bought in boats with the money we've saved him, like literally boats, because you can save $35K in a single year depending on your holding. And I guess really important is some of you watching this already own real estate and you're like, damn, I wish I knew this. The beautiful thing is depreciation doesn't go away. It's like an account. So if you've been line depreciating, you haven't been taking the lion's share. Those assets, because they're already in service prior to the year you're trying to save taxes, you can then take a cost seg study on existing holdings and then do the depreciation to offset active income for this year. Is that correct?
Yeah, you can definitely do a cost seg on assets that have already begun their depreciation. Don't let your tax professional talk you out of it. I'll admit it's gnarly from an accounting perspective, and the form that the IRS has us fill out, the form 3115, it's intense. It's intense. Don't let that be the reason that your accountant or your tax professional talks you out of it. That's what the form was actually created for, was to say, hey, we were depreciating it this old way. We want the bonus. We want the better advanced way. And this form allows us to make that switch.
I mean, and you're not going to make me fill that out, right, Rick? I mean, at the end of the day, if I'm working with you, that's something an accountant would do for you.
There would, but yes, you're right. But the other day I had someone come to me and says that they had a meeting with their CPA trying to do some planning, and the CPA was talking them out of doing things because he didn't want to do the work. Blew my mind. Yeah. But people like that exist in the world.
They're all over. Actually, that's most of them. And I guess that's really something I want to hammer down is like if your CPA is talking you out of this, it's because they're not interested in your benefit. They're interested in theirs. And you have to have some conviction in what you're trying to accomplish. Like you need to take on the work of educating your position so that you can lead your team. Like Rick, you're a very valuable team member, but I am pretty clear about where I'm going, which is what makes you valuable. You helped me get there. If I had no idea, we probably wouldn't be a great match.
Probably so. Probably so. And so, with this cost segregation study stuff that we're doing, we had a client the other day that they have a commercial building. It got set up under standard depreciation, kind of the easy standard method. We came to them and said, hey, we can do this particular approach that we're talking about. Worked out perfect because they got some federal rebates and grants that they weren't expecting that came in. Because we had done this cost segregation approach, it offset the other federal grants and awards they were getting, and the timing just became perfect. And had I been lazy and said, I don't want to do that kind of work, it would have cost my client a lot of money. And would they have known? No, probably not. But I would have known. I can sleep better knowing I'd help my clients out and work in their best interest.
And there's nothing that feels better than you walk into the end of tax year like, oh man, I hope this doesn't suck. And then your accountant tells you you're getting a rebate. Like I'm telling you, Rick, that's been so wonderful every year. Most agents, they sit there with some money in an account. They hope it's enough. They've been trying to skim 30% off the top because that's like this rule of thumb that industry professionals talk about. That's underutilized capital. It's done nothing for them if they have saved it. And then they give most of it over to the government because they didn't have a strategy in place. Where like a lot of times people talk to me about, well, do you have your kids on payroll and did you rent out your house for a week? I'm like, I don't care about any of that stuff because the amount of work it takes to save $900 at the end of the year, I may as well keep that money moving through real estate and take advantage of the depreciation piece. So it almost makes the rest of the strategy irrelevant if you're willing to be aggressive and move through the asset class.
Yeah, and you and I get to have those conversations throughout the year and before the year's over. So it's not a surprise. Rather, it's just a report card come tax time on how well we did in our planning, and it's always rewarding and satisfying on our end when we get things filed and prepared and they match the conversations and projections we had the year before.
Well, do me a favor, Rick. I mean, I think you should talk about your business model because I don't think it's necessarily your average CPA's business model. And also, like, you're mentioning things that are very valuable to me, like access to you throughout the year. And you're keeping the books for my top level companies so that there's not some question about where we are. Like, I'm pretty sure that's a unique offering. I hadn't found it, or at least I haven't found it executed well until I met you. So tell the guys a little bit about like what you offer and how that works.
Thanks. Yeah. I actually won an award in 2023 from Thomson Reuters, worldwide professional services support organization. They gave me an award called their Advisory Accelerator Award at their annual convention. I'm the first person ever to get this award. It's an inaugural award because we really changed and transformed the way that CPA firms interact with their clients. And so I was on the hamster wheel of I'd meet with my clients once a year, tax season, tax time, get the numbers done, give a number. All right, call me if you need me, see you next year. And one day I just scrapped that model. I just said, this is not fulfilling. It's not fun for the clients or me. And Luke, I wrote down a Post-it note. I said, if I'm given my perfect service cycle, what does that look like? And I said, step one. I wrote down a Post-it note, put that Post-it note up on the wall. Then I said, step two, put on the Post-it note, put that Post-it note on the wall. Then I said, well, okay, but if this, then that. Pretty soon after about an hour, I had like a conspiracy theory wall on my
Everything tied together.
connecting lines and stuff. And as I looked at it, what I realized, my epiphany was it's all rooted in one thing, education. And education, I think, is a two-way street. It's not just me imparting knowledge to my clients, telling them, hey, here's how the tax code applies to you. It's me learning about my clients. What's your lifestyle? As you said, what's the direction you're going? What's your vision? Tell me about your family life. The more that I can learn about my clients and know my clients, the more time we can spend together, the more I can say, oh, hey, this applies to you, and we can execute. That's where a lot of people, I think, fail, is the execution. So our model is one that we don't just talk to you once a year. There's access, as you use that great word. We have a cadence where we require our clients to meet with us a minimum number of times a year. And if someone says, no, I don't want to do that, then we say, you're probably not the good fit for us. Our model is all about access and being proactive. When we bring on a new client, we put them through a series of meetings and conversations over the course of a month or two, because we want to get to know you. We want to dive deep. Can't do that once a year meetings. And then from there, we're able to build out a personalized plan and approach, and then have the ongoing meetings throughout the year to make sure we're executing appropriately. Or, like you said in your business, sometimes it's feast, sometimes it's famine, comes at once. We want to be able to be there and be accessible so that we can adjust and adapt, kind of like a pit crew in a race.
No, and that was my exact experience with you on our last meeting. And you're like, well, we're a little behind where we were this time last year. And I'm like, yeah, but the next 3 months, because it definitely is, it ebbs and flows. And to have somebody watching my back on that stuff and helping me sort of project, should we or shouldn't we be buying going into the winter season so that we can offset this year's taxation, So it's just really helpful to have a check-in. It's almost like accountability. From an entrepreneur's standpoint, it's like I can just be out there in the woods sharpening sticks if nobody's like, hey, what next? So it has given me a cadence. It's like a good team member helps you get better. And like I think that's been a great part of our relationship is, iron sharpens iron. And it's obvious to me too that you're passionate about building your business. It's not just, well, we're CPAs because it's a proven business model. It's like, well, how can we make it better? And like that's an obsession of mine. We had a great lunch one time where we were just chewing apart each other's business models. Like how could this get better? But that's been my experience working with you, Rick. So good on you for keeping me as long as you have, because I'm happy to be here, man. You've been excellent. And dude, I don't pay taxes. That's crazy, guys. I make a lot of money and I get a return. My return this year was $20,000. That stuff's crazy. And like, I don't exactly know how it works because Rick's got my trust, but the idea, the business model your CPA brings to the table is as important as the business model you bring to the table as a real estate agent. There's not a way to do it other than you trying to make it the best way, So when you're out there, like, Rick, I'm going to reiterate your business model to you to make sure I understood it. It's, first of all, we pay you monthly as a team member, and then access to you is predictable and rhythmic while you stay involved in our business and vision.
Yeah. And then you have something that comes up during the year. All of a sudden there's whatever item happens in your life and you need access sooner than what we had scheduled. Great. There's no extra bill.
Right.
Not like I'm not going to bill you for this phone call or bill you for that email kind of thing. I want to be a resource for you.
Yeah. And that's been great. And then what I pay you ends up being part of the tax return cost anyway. So budgeting for taxation is simpler. It's just the whole thing made more sense in my business. So I think it's been great for me. But as you guys are out there looking for your CPA, Rick's on my team for a reason. So if you need one, holler at me. I'll get you in touch with him. Rick Sager, this guy's been awesome, guys. I hope today's conversation helped you too. But I'm going to make sure you get in touch with this guy if you need a strong player on your team. Thanks for being here, Rick.
My pleasure, Luke. It was a lot of fun. Appreciate it.
Absolutely.